You know, I've been doing this for almost 20 years, and I've met all sorts of people when it comes to their retirement planning, and most people want to save money in taxes. But when it comes to charitable giving, I ask them, hey, do you like to give to charity? And a lot of times they say, you know what, no, we're more family inclined. But did you know that if you plan a gift, the IRS forgives a tax? That's what today's show is all about, is giving to organizations that you truly care about, but also understanding the true benefits that the IRS gives us when we do that planned giving. Welcome to the show, everyone. Joe Anderson here, certified financial planner, president of this company here, Pure Financial Advisors. This show just would not be a show without the big man, Big Al Clopine. He's sitting right over there. We're going to change the show to Tax Chat with Big Al here, I think, in the next season, because that's all we're going to get into today is taxes and how you can reduce your overall tax bill, but also make a true impact in the world. That's today's financial focus. $282 billion were charitable gifts by individuals. $282 billion. I think that number could increase if we were a little bit more educated in regards to some of the strategies that you can absolutely utilize. Sometimes we think we have to be extremely wealthy to give to charity. That is just not the case. If you want to reduce your tax bill a little bit, if you want to help out an organization, there's some things that you can do. To help us break it down, let's bring in the big man right now, Big Al Clopine. First things first with planned giving, right? You want to make sure that, hey, I want to give to an organization or a cause. But I think a lot of times, Al, is people really don't understand the IRS gifts, that when people do plan a gift, of what the true impact is to their bottom line.
Well, I think that is true. So I guess the point, and I agree with you, is first give to who you want to give to. But then it turns out there's an ancillary benefit, which is income taxes, and not everyone realizes what those benefits are.
Right.
So that's what we're going to focus on today. You guys know what charities you want to give to. We're going to explain the potential tax benefits for you. So right off the bat, we're going to get into basics. Some of this you may know, some of it might be actually new to you. We're going to talk about non-cash donations, giving to Goodwill or other Salvation Army, other organizations like that. We'll get into giving appreciated securities. This is actually one of the best ways to give to charity. We'll explain why. Donor-advised funds. Some of you may know about those, and many may not. A donor-advised fund, it's a way for you to give in future years, but get a tax deduction today. That's pretty valuable if you're in a higher tax bracket. And then there's all kinds of other planned giving strategies that we want to get into. Because a lot of times people think, you know what, I'm just going to write a check to charity, and that is a way to go. But there's a lot of other things that you can do, Joe. And I think it's, if people kind of understood what the benefits, the tax benefits are, they might be inclined to give a little bit more.
Yeah, exactly. A little, I mean, depending on your tax bracket, depending on your overall situation. But if you can combine this with your overall financial plan, you know, I think you can add a little bit more. So let's just do this. Let's start with the basics when it comes to charitable giving.
Yeah, and right off the bat, you can obviously give cash or a check. You can give non-cash donations. That could be clothes, household goods. It could even be an automobile, something like that. Certainly you can volunteer your time. A lot of you guys do that. And then there's all kinds of planned giving strategies. And sometimes planned giving strategies are things like, you know, a charitable gift annuity or a charitable remainder trust. And there's ways that you actually get some benefits back to you in addition to giving and getting tax benefits. So
I think one of the bigger questions that we get, and I think we've had a couple email questions on this show, is about volunteering your time. Hey, I'm a doctor, and I'm going to a third world country, and I'm going to spend, you know, a month, and I'm going to be giving up my income. Can I write that off on my tax return? And Al, what's the answer to that?
The answer is no, because unfortunately, when you give your time, it's not a tax deduction. The reason it's not a tax deduction is you never got earnings that you paid tax on to give them away. So just realize, if you're a professional like an accountant, attorney, doctor, something like that, if you give your time, well, that's great, but that's not a tax deduction. Interestingly enough, though, if you spend money on behalf of a charity, maybe traveling to a charity to do a charitable function, then that travel time can be deductible. So realize that.
So yeah, well, let's get into it. Let's look at how do you receive a tax benefit here?
Yeah, typically, Joe, you've got to itemize your deductions. So we know that there's a standard deduction or an itemization if you have more deductions than a standard. So you have to itemize to get any sort of benefit of charity. You got to give to a qualified charitable organization. You ought to keep your receipts, cancel checks, and so forth. And then if your contribution is more than $250, you actually have to have an acknowledgement of benefit directly from the charity. And in fact, if the IRS audits you, Joe, and you don't have that statement from charity, they will disallow it. That's a requirement now. If your contribution is more than $250, you need that acknowledgement. Fortunately, the charities know that too, and they will send those out.
Question. So the DAV, the Dave, right? You know what that is? So they sent this bag and said, hey, if you want to give some clothes or whatever, right? Yeah. So I put a bunch of old suits. Okay. And I don't know, it was probably 5 suits. You might not be able to tell, but these are fairly expensive suits, right?
Really?
Yeah, but I don't keep the receipt, or whatever. That's $500, you know, whatever. I'm not even going to get there. But right, I didn't save my receipts. They just said, here, they just gave me a tag. So is that going to hold up an audit if I put like $5,000?
Well, not $5,000. The thing about like a non-cash donation is it really needs to be like a thrift shop value. In other words, what you could sell it for at a garage sale, something like that, which, by the way, is probably maybe 10% or maybe 20% of what you paid for it. So, Joe, if you paid $200 for the suit, maybe you could deduct about $20.
$200.
Something like that. I'm just thinking.
$200. Thank you.
But let's talk about non-cash donations a little bit further. So if in total, if they're less than $500, you just put it right on your return. On Schedule A, you don't need to disclose anything. But if it's over $500, you got to file this special form, 8283. You have to disclose what items you gave away and to what charities. If it's over $5,000, like all your suits that are $5,000, you got to get an appraisal, brother. You got to have an appraiser come out and say, you know what, this suit, these suits,
yeah, right.
If you can get an appraiser to do that,
yes, I'm going to.
Then that might be pretty good.
Yeah, pretty much.
So it kind of brings me to the point of non-cash is be careful on your valuation because the IRS is, they're kind of savvy to this. If you spent $1,000 or $2,000 for a suit and that's what you claim, it's not going to fly.
Right. And then I think a lot of mistakes that we make is that we might be giving cash to a charity where you have appreciated stock in your portfolio. That might be a better option because you get a double whammy here. So let's say if I bought a stock for $1,000 and the value of that stock is $10,000, it doesn't have to be a stock, a bond, any type of capital asset. So if I give that to the charity, and let's say, assuming I'm in the highest tax rate, I get almost a $4,000 tax deduction for that $10,000 gift. But I also avoided selling that stock because I just gave it directly to the overall charity. They sold the stock, didn't pay any tax, so I saved about another $2,000. So my total tax benefit is 60% of my overall gift, given, depending on, what tax bracket that you're in.
Yeah,
so I'm sorry, go ahead.
I was just going to say, Joe, and of course that's maximum federal tax rates for 2017, but that doesn't even include state. So really your benefit may be even greater.
Right.
Depends upon your situation, of course.
And mistakes we see is that, all right, well, here, I want to sell the stock and then I'm going to gift the cash to the charity. Well, no, just give the stock directly to the charity, so that avoids that capital gains tax entirely. All right, we got to take a short break. When we get back, we got a special guest that's going to break down this stuff even more, so you don't want to miss that. Hey, welcome back to the show. The show's called Your Money or Wealth. Joe Anderson, Big Al hanging out here, talking about charitable planning and taking a look at how you can give to some organizations, but also what is the benefit to you by doing that. Before we get into that, let's go to the true-false question.
If you give more charitable donations than you are allowed to deduct, you can carry them forward to future years. True or false? Well, that's actually a true statement. In fact, the way this works generally with a charitable contribution, if it's a cash or check contribution, you can deduct up to 50% of your income. If it's appreciated stock, it's 30% of your income, and any remainder carries over to the next year. It can carry over for up to 5 years. So the answer is yes. If you make a large gift this year and you can't deduct it all, you can take it into next year.
Yeah, that's key. And then because of the appreciated stock, it's 30% because you don't necessarily have to pay the capital gains tax on it, so you get a little bit less, but you can still carry it over. Speaking of getting larger deductions in a given year, there's something that's called a donor advised fund, which some of you might have heard of, but I think a lot of you haven't. We use this technique quite a bit, is looking at, hey, if you want to give to a charity, but maybe you have a very high income year this year because of restricted stocks or you had a huge bonus or whatever the case may be, is that you can kind of front load your overall deductions or your contributions and get a fairly large deduction in 1 year. For instance, let's say if you're giving $10,000 to a given charity, you can say, all right, well, for the next 5 years, I know I'm going to give that $10,000 into that charity, but I want a big deduction, so I'm going to put $50,000 into this donor advised fund. I get the deduction that year, and then I have 5, 10, 15, whatever you want to dish out those deductions or those contributions at any time that you want. Let's get in a little bit deeper here when it comes to planned giving or gift planning. We have a very special guest today. There's been a lot of disasters, I guess, over the last couple of months with the hurricanes that hit Houston and Florida. And a lot of you probably gave some gifts. So we have the director of gift planning, Erin Jones. She's from the Salvation Army joining us today.
Thanks so much for joining us.
Thank you so much.
So let's start with the Salvation Army. So what's the purpose of that organization? What's the charitable purpose?
It's pretty simple. For 150 years, we save souls, we grow saints, and we help the less fortunate.
Okay, 150 years. That's excellent. So right now, as Joe mentioned, of course, we had a lot of hurricanes, and there's a lot of victims. What is the Salvation Army doing for them?
Salvation Army is truly boots on the ground. We are there right now serving thousands of meals, helping with shelters, bringing water in. You won't see our name a lot of places because we're very humble about what we do, but we are there on the front lines helping those in need.
Is this something that you will come in and help out for a couple of weeks or a month, or could it be a year or a couple-year project?
Absolutely. This will definitely be a many-year project. We stay there until the job is done. We don't just put a Band-Aid on it.
So like in New Orleans in 2005 with that hurricane, how long were you there?
We were there for several years, making sure buildings were put back together, people were getting jobs, clothes, and really got the resources to get themselves back functioning again.
Okay, good for you. So let's talk about the different ways people can give to the Salvation Army.
Some ways people can give is certainly they can give their clothing and personal items to our thrift stores. They can give cash donations. They can give online. They can give automobiles. So there are very different ways people can give. As the director of gift planning, I work with those generous donors who want to specifically put us in their will or their trust, or there are ways they can give during their lifetime and receive immediate tax benefits as well as an income stream and become a philanthropist.
So let's talk about gift planning, because I think a lot of people don't really realize you can do more than just give cash or check or maybe old clothes and that sort of thing. What is gift planning or planned giving?
Gift planning, planned giving is the estate planning side of fundraising. It's a way for you to avoid capital gains taxes, a way for you to get an immediate tax deduction and receive an income stream, which in many cases will be higher than the income stream you're receiving from that appreciated asset to begin with.
So what would be an example of one of those strategies?
We have a charitable gift annuity program. We have hundreds of donors in our region who have set up these gifts, as well as thousands across the United States. The minimum investment is $10,000. You make the investment, and then you receive a fixed income stream that's guaranteed for the rest of your life. You simply cannot outlive your income. The interest rates are established solely on your age. The older you are, the higher the rate. An 82-year-old can expect to receive somewhere in the area of 7.5%. A 90-year-old will get 9%. And that, again, is fixed and guaranteed for the rest of their life. They'll get an immediate tax deduction for doing it. But here's a great component. a good portion, sometimes 80% of their income stream, will be tax-free to them for their life expectancy. So although they may be getting a 7.6% return, their effective tax rate may be as high as 8 or 9. They can also fund it with an appreciated asset, therefore avoiding the capital gains at the onset of the gift. Part of their income stream would be considered capital gains, but as you know, Al, capital gains is typically a lot lower than ordinary income.
So I've got a stock that I bought for $1,000 years ago. It's worth $10,000. I give it directly to Salvation Army in exchange for a gift annuity, right? And then I get a current tax deduction. I get an earning stream for life, and that's tax favored, you're saying?
Absolutely.
So where do I sign up?
Where do you sign up? Well, fortunately, it's just a one-page contract that we can put right in our office, put together for you.
Fantastic. So that's one strategy, and we have maybe time for what would be another one?
People who have more assets, such as appreciated property, an apartment building by chance, maybe they don't want to be landlords anymore, they want to travel, but they know they're going to take a huge hit with capital gains taxes. They could take that asset, transfer it into the charitable remainder trust. The trust gets to sell it tax-free. The income they'll receive off of that will most likely be more than the income to begin with, and they become a philanthropist. They're also going to get the immediate tax deduction that you alluded to earlier. You can carry forward for 5 additional years. They're going to receive a generous income stream. One thing people say when I describe this strategy, it sounds great, but you know, we have kids. We'd like to give this to our kids. Well, considering their income stream will most likely rise, and people who are in their 70s and 80s don't go out and change their spending habits, they could use that additional income to buy a second to die life insurance policy, basically replacing the asset for their children. So it's a triple win. You benefit charity, you avoid capital gains, immediate tax deduction, help your children, and become a philanthropist.
Well, that was a lot said in a short period of time. So let me see if I can summarize. So you have an appreciated property like an apartment building or something like that. You give it directly to charity. You set up a charitable remainder trust is what you do. You get a tax deduction currently, and usually it's somewhere around 10% of the value of the property. And then you get a lifetime earnings stream as long as you're living, right? Which, one of the main advantages when you put that asset in, the trust sells it and doesn't pay taxes currently. You get a lifetime earning stream. Of course, you'll pay taxes on that, but generally most of that's at a capital gains rate. So it's both of these strategies that we just mentioned. It's kind of what we call a split gift. In other words, it's part charitable, but it's part some money coming back to the person that's giving.
Absolutely.
So great. That's a great way to go. So we could probably spend hours on that, Erin, but I think that's a good summary for right now. I really appreciate you spending time with us, so thanks for coming over.
Thank you, Al.
All right, great.
You know, this is a ton of great information, and what we're also doing is that Erin Jones, we've paid her a lot of money. I think it's $5 to do, and it was a gift, to do a full webinar on all of these different strategies. So if you're curious, go to yourmoneyyourwealth.com. We're going to have a lot more information, a lot more detailed information, how you can give to the Salvation Army or any other charity of your choice and use these same strategies. Don't go anywhere. We'll be back to wrap up the show in just a second. The show's called Your Money, Your Wealth. Hey, welcome back to the show. The show's called Your Money or Wealth. Joe Anderson, Big Al, hanging out. Thanks for tuning in today. We're talking about charitable giving and how it can affect other people, but also how it can affect you. We're going to flip the show to you and answer your email questions. But before we get to those emails, let's see how you did on the true-false question.
If you provide volunteer legal or accounting services to a charity, you can deduct your normal billing rate as a charitable deduction. True or false? What do you say, Joe?
Well, if they were watching any part of this show, they would know this answer.
They would, wouldn't they?
Yeah, but I guarantee you.
Do you remember?
No, I don't. It's false. It's false. You cannot. If you're volunteering your time, you cannot claim that time as a charitable deduction. So. Good try, but you cannot do it.
That'd be cool if you could, though, because You know, you and I, of course, charge ourselves out at about $4 an hour, but we could say it's $400 an hour.
Yeah,
right?
exactly.
And get
right.
a big, huge deduction. That'd be cool.
Giant. Yeah, my $200 suits. So, hey, let's do this. Let's flip the show to you. There's a bunch of emails. Let's get right to it.
Okay, number one, Lupe Benita. I want to give my inheritance of $525,000 to the American Red Cross. How much will I be able to deduct from my taxes either this year or over time? I make $320,000 a year. Wow, Lupe, well, good for you. You've got the inheritance and your situation is strong enough that you don't necessarily need it. You want to give it to charity? Love it. That's great. Now, there are limitations, and here's what it is. Cash donations, which is what this would be. So you take your income, $320,000, and you get to deduct 50% of that. So that's $160,000 as your tax deduction. It's not your tax savings, it's a tax deduction, right? So if you're in a 25% tax bracket, you would save about $40,000. Now the rest of the donation, then that would carry over to the next year, and you can carry it over for as many as 5 years, so you will get to use it over time. Now, just for the rest of you that may want to think, well, what if I gave away an appreciated stock or some kind of appreciated property? Then you can deduct 30% of your income. So 30% is $96,000 in that example. So just be aware that when you give to charity, you can take a nice big deduction, but you can't completely zero out your income.
Only 50% and 30%, but he could carry that over then.
Carried over. In both cases, you carried over for 5 years. So really, you can take the deduction in the year that you make the donation, and then for 5 more years after that.
Yeah, so then that's where the planning comes into play, right? You got to take a look at what your income's going to be if you want to make a huge gift like that, just to kind of plan that out so you don't leave any of that tax deduction on the table. Let's go to the second email.
All right, this is from Lou in La Jolla. I want to sell a property that has appreciated nicely over the past decade, but it doesn't produce income. I want to buy another income-producing property. Is there a way that I can avoid or minimize my capital gains taxes? Well, Lou, that's kind of an interesting question. You got a property that doesn't produce income. So what does that mean? Is it a piece of raw land or is it your residence?
I thought you were going to say something else.
You did?
Is that a piece of?
This is a G-rated show, Joe. So I'm going to try to
I'm
answer.
confused. Why is it this creating income? Is it a piece of raw land?
I'm going to try to answer the question.
Oh,
so first of all, you could do a 1031 exchange, right? You can sell an investment property and buy another one. Generally, you want an income-producing property for another income-producing property. There's a couple exceptions. So that's a way to defer the taxes. Now, when you sell that second property, you'll pay the taxes. Or if you hold the property all the rest of your life, your heirs get a step up in basis, and then they don't have to necessarily pay the tax. You can do something like we just talked about, a charitable remainder trust, where you put the property in the charitable trust. You get a tax deduction today, usually for about 10% of the value. The trust sells that property, pays no tax. You get a lifetime earnings stream, but realize this: when you pass away, whatever's left over in the trust goes to charity. That's how it's tax exempt. That's how you can sell it without paying taxes currently. So there's a couple ways, but I would encourage you to actually look at what happens if you did sell it and pay the tax, because sometimes it's not as much as you thought, because maybe you have capital loss carryovers or passive loss carryovers or all kinds of things. So it's a little tricky, but there's a lot of ways to go to save taxes on a property sale.
Tax chat.
Tax chat, that's right.
Yeah, we got it. Let's wrap this show up. Let's see what else we got there. Do we got another email question for Big Al?
I think we do.
Okay,
Number 3. So Mary Beth Poway, I want to roll income from my charitable remainder trust back to the designated charity. Can I stop taking the payments and use what the payment amount would have been as a tax deduction? All right, Joe, this is Tax Chat, but I'm going to turn it over to you. What do you think?
Well, I think this is, I don't really understand the question. I think she put something into a charitable remainder trust. She didn't pay the tax in selling it. The trust paid the tax and paying her an income stream. So she's receiving that income stream. So it sounds like the question is, hey, can I stop that income stream? Let's say it's $20,000 per year. Can I stop the $20,000 per year, redirect that back into the charity, but then also get the tax deduction as a $20,000 gift, hypothetically given those numbers? The answer is no. Here's what you can do, however, right? Because that income is going to come out to you. You have to still pay a little bit of tax depending on the characteristic of how you invested in the trust, what the capital gains is, and everything else. So then you take that $20,000, you pay a little bit of tax on that income, then you can redivert that $20,000 and give it directly back to that charity. I think you were trying to double dip there, Mary Beth from Poway, but God bless you for giving. Hey, that's it for us. Hopefully you enjoyed the show. Want to thank Erin Jones from the Salvation Army. That was fantastic. For Big Al Clopine, I'm Joe Anderson. You just watched the last episode here at KPBS Studios. God bless everyone that's helped us out over the year. I love you all.